Bloomberg Audio Studios. Podcasts, radio, news.
But we begin with our very special contributor, Larry Summers of Harvard, as we address what the Fed decided this week, what we heard from Chair Powell, and also maybe a little microeconomics before we're done. So, Larry, thanks for being back with us. Let's start with the Fed, though. What we heard, I heard more growth, less inflation, low unemployment. That sounds pretty good to me. Is it too good to be true?
I don't know. Certainly there's been some encouraging data flow during 2023, though the last 2 months haven't been quite so encouraging. It's great and right to hope for the best, but hoping isn't planning. And certainly from that scenario laid out in the dot plots, I think there's more room for things to surprise on the bad side than to surprise on the better side. We may have the path that's described there materialize. It's certainly got to be recognized as a very real possibility. My sense is still that the Fed is itchy fingers to start cutting rates, and I don't fully get it. We've got unemployment, if anything, below what they think is full capacity. We've got inflation, clearly even in their forecast for the next 2 years, above target. We've got GDP growth rising, if anything, faster than potential. We have financial conditions, the holistic measure of monetary policy, at a very loose level. I don't know why we're in such a hurry to be talking about moving towards the accelerator.
So we heard from Chair Powell that, in fact, he thinks these conditions are restrictive right now. They're decidedly restrictive, even if we're not seeing a lot of restriction. But that depends in part on where the neutral rate is, something we've talked about before. I still don't get a sense from the Fed that they figured out where they think the neutral rate is. And do they need to know that before they can decide where they're going?
They need to take a view, because if you don't know what's neutral, you don't know how expansionary or restrictive you're being. And I find their view that the ultimate neutral rate is 2.6 to be bizarre in current circumstances. Here's what we have relative to a few years ago when they said it was 2.5. We've got fiscal policy in a much, much more expansionary place with much higher deficits, much larger role of debt. That puts pressure on credit markets. We've got a huge set of new private sector investments going on with respect to green investment in the IRA, going on with respect to resilience and reducing dependence on single sources. We've got a potential huge source of demand for chips and for electricity coming out of the AI revolution. And we've got a huge wealth effect as markets for both housing and stocks have run way up for the last few years. So with all of those impulses to demand, I cannot understand why someone would form the view that the neutral rate was essentially the same as they thought it was 4 years ago. And I think the neutral rate is far more likely to have a 4 handle on it right now than it is to have a 2 handle on it. And from that perspective, I'm not at all sure how restrictive monetary policy really is. And the proof's really in the pudding. Monetary policies by now had a very long time for the lags to work through. The transmission variables, stock prices, interest rates, long-term interest rates, credit spreads are flashing green and loose, and the economy keeps surprising on the high side. So either if you look at the fundamental determinants of neutral interest rates, or you look at how fast the economy is growing, seems to me you've got to read a high neutral interest rate, and I just can't understand why the Fed is talking about 2.6 as a best guess. I would be the first to recognize that This is a number that fluctuates, that we can't gauge it precisely, that economists don't have great models. So I'm not saying that I'm sure that they're wrong. I'm not. But I think the challenge in policymaking is to try to make best estimates where you're equally likely to be wrong in both directions. And the chance that the number's much greater than 2.6 seems to me far greater than the chance that the number's much less than 2.6.
Larry, you mentioned the effect of fiscal policy. We also have a new budget that's out right now. It doesn't look like we're going to constrain our spending anytime soon. So how does that figure into anticipation of future inflation?
Look, I think that when you have more expansionary policy, you're tending to have more pressure for high inflation. I'm also very worried about the shared assumptions around national security spending that are reflected in all the various budget blueprints around. I can't really believe that with all the things we're learning about national security threats over the last year or two, that the right medium-term budget plan calls for defense spending adjusted for inflation to fall over the next couple of years, or for it to stay constant and decline substantially as a GDP over the full 10-year budget horizon. So I think we've got a kind of implicit liability and an absolute need for our national security to be thinking about more robust defense spending and building up the defense industrial base in the years ahead.
Larry, it occurs to me that there are policies going beyond monetary policy that could well affect future inflation. I'll mention a couple of them. Trade and tariffs, which tend to be inflationary. President Biden really didn't back off of what President Trump did very much. Now we have a candidate Trump who's going even further. And by the way, immigration. It seems like we're going to constrain immigration. And if you really constrain the growth of the workforce, as I understand it, that is inflationary. What are the other factors that might be driving inflation?
Look, David, part of the story of the great moderation of low inflation for 40 years has to have been the ways in which globalization held down prices. Flows of capital that promoted productivity-enhancing investment, flows of workers that enhanced labor supply, lower-priced goods that provided competition. The best forms of competition we get in the U.S. economy are often from imported goods. And so if globalization held prices down, it follows that deglobalization will tend to push prices up, which will mean for some interval higher rates of inflation. And I don't think the prospects of tariff increases, of reductions in immigration, of more restriction on foreign investment and what that means for the dollar, I don't think that in consensus inflation views. And so I think that's another upside risk to inflation. And frankly, it's one that would be substantially exacerbated if the Trump economic program, at least as it's been described in recent months, were to be implemented.
So you mentioned a flow of capital and foreign investment in the United States. We have a specific instance right now in the instance of TikTok in the bill that's passed the House, not passed the Senate. What do you make of that issue of trying to divest, actually, TikTok being divested by its Chinese partner, and particularly compare and contrast to something we've talked about before, which is U.S. Steel and the Nippon Steel investment into that?
Look, without access to classified information, it's difficult to make a definitive judgment on either of those cases. I would just say this. It seems to me all but self-evident that the threat to U.S. security from our Chinese adversary controlling the news feed that is a primary news feed to more than 100 million Americans has to be vastly greater than any risk from our staunch ally, Japan, having a private company own less than 15% of U.S. steel production. And so it seems to me there's just a very clear disproportion in the risks in those two cases. And I hope that will factor into our decision-making going forward.
And finally, Larry, you've talked on this program, so some questions you have about antitrust enforcement policy by the Biden administration. You've questioned about the allocation of resources. But we do have a fascinating instance right now in the real estate market being really redone. What do you make about the realtors' fees decision?
Look, I've been very critical of competition policy in the last few years, but this is a huge win. The process of buying and selling houses in the United States is probably as egregious an example of special interest politics putting huge burdens on consumers as anything else we have. And breaking the realtor cartel is something that could have benefits that could be $100 billion or more over time to American households. And I'm really glad to see this start. I hope we will build on it. In other countries, that commission number that is 5 or 6% in the United States is more like 2%. And by the way, with all the tremendous progress we've made in digital technology, the whole need for the personalized service of realtors has substantially diminished. So in addition to the international comparison, you have the capacity of digital technology. You can now, as a matter of routine, do something that's a pretty good tour of a house with a video or with 40 still photos of every room. That's got to reduce the need for realtor services. In the era of the electronic signature, the whole set of complex rituals associated with making offers on houses, associated with house closings, there is huge capacity to take cost out there, and that is a place that I think we can do a ton for Americans. And when you take the frictions out, here's the important thing, David. When you take the frictions out, it's win-win, because it can mean that the cost of buying a house is lower, at the same time that the cash that an owner can get out of their house is higher, because you help both of them, because you're taking the friction out and you're taking the prospect of future frictions out. So I think this is a really promising area for public policy. I was glad to see the president refer to the whole housing area with such emphasis in his State of the Union address.
Larry, thank you so much for being with us as always. That's our special contributor, Larry Summers of Harvard.